Greetings from the St. Louis ADK office. Hope you're doing well. It's kind of toasty outside here in St. Louis, where it appears as though we've skipped spring and jumped right into summer. Focus for today is really around the economy. It appears as though that we've been in the second longest economic expansion post-World War II, and most likely that will end up, when it is all said and done, being the longest. While it's been rather long, it's been very mooted in that the growth rate has been tempered and kind of low. You could classify it as a extended slow growth. And the key question is how long will it last? LPL has 5 key indicators that they use, and if you do the average of how long it would be before a recession, it'd be about 2 years out. Averages can sometimes be a little misleading, so when you really break the numbers up, the shortest time frame was 7 months historically, looking post-World War II. If you take a look at recessions in general, what causes recessions? According to Dr. William Emmons, the PhD at the St. Louis Fed, there's really 3 things that cause recession. One is that the economies go on and just get overheated, so overextended. So for example, you take a look at 2001, you had many sectors in the economy, specifically in tech, things like broadband, et cetera, that just got so overextended there was enormous glut. It was also extended in the stock market, and you saw a recession. Another is that financial conditions really deteriorate. So for example, there you take a look at 2007, where you had the U.S. real estate market create a subprime debacle that rippled through the financial markets in the developed world, specifically Europe and U.S., and the conditions just came unbundled in a way that you often hear is the house of cards. And then the third is what I'll classify as shock, whether or not that's around sentiment or some kind of a supply shock. 2 that come to mind: early 1970s, you had Nixon take us off the gold standard, which really sent a shock to the system that was really predicated post-World War II in the Bretton Woods negotiations. Second, you could take a look at the OPEC oil crisis, or even a little bit further out, you could take a look at 1990 when Iraq invaded Kuwait. So what are some kind of shocks that could happen now? The most recent news, we see that it appears that Trump and China have avoided trade war. You saw in my last video that I really didn't think that was a real risk. I still don't, but a trade war would be a shock. North Korea, at this particular juncture, negotiations and saber rattlings going on, but it appears as though that risk has cooled itself down for the short term. One that I think is most likely, if we were going to have a shock, would be central banks having a misstep and tightening too quickly. If we avoid a shock, my opinion is that we're talking no recession 2018, 2019. If you sort of shift gears and have another supporting reason for that rationale, you could take a look at the S&P 500. We just recently finished earnings season reporting, and it was nothing short of remarkable. So with the S&P 500 having grown year-over-year earnings at a 26% rate, in my 30 years doing this, there's less than a handful of times that I've seen that kind of growth rate. Now, you could also say that 7-8% of that growth rate was because of the tax plan, and I would agree with that. So really you're talking real growth rate, not an artificial one-time jump of, call it 18-19%, super strong. And revenue growth at about an 18%, and the forecast for earnings going forward is solid. LPL believes that we've hit an earnings growth peak. I want to reiterate, that's not earnings peak, but earnings growth peak, so that they believe that earnings will continue to grow, but at a decelerated rate. And historically, that would mean that a recession's 2 years out. There's nothing more that I would really add to our last quarter market update. So if you haven't watched that, I'd take the time to watch it. In summary, I would say that it's my view that barring a shock, some kind of a Federal Reserve misstep, ECB misstep, trade war, North Korean nuke kind of a thing. Hard to imagine a recession before the 2020 timeframe. And just to bring you up on personal health, today as we're videoing this, it's March 23rd. I had my last radiation treatment today, feel pretty good. I have been needing to go home midday and take naps, and I appreciate your patience. I know some of you have called in, and my response time's been a little bit lower than normal. I'm told that next week my energy levels will hit sort of the bottom of what they're expected, and then slowly I'll regain. And I appreciate your patience through all this, as well as your encouraging wishes. As you go through a health challenge like this, you really do start to evaluate what's important to you in life, what are you thankful about. And one of the things I'm very thankful for is your partnership and the relationship that we've had over the last 30 years. I want to say thank you very much. Also want to reiterate that we're expecting to be able to grow the business, call it like 5 or 6 new clients a year. And if you're able to refer people to us when you come across situations like they're retiring, there's a death in the family, sometimes someone was handling the finances, they're dissatisfied with their current financial advisor, or their financial advisor retires. Those kind of what we call trigger events are times where it's appropriate and helpful to refer. We'll never ask for names because we believe that that puts you in an awkward spot. But in those appropriate situations when you refer someone to us, probably 2 things to be able to do that makes it smooth for them. One is to direct them to our website, discoverindependence.com, and 2 is ask if it would be okay if you forward their contact information to me. Sometimes that's just an email and then I email them. Other times it's a phone number, whatever's most appropriate for them. So signing off from St. Louis, thank you and enjoy your upcoming summer.